So get ready here because I'm about to take a huge deuce on Shake Shack. All right, hey everyone, welcome back. It's Tuesday, and you know what that means. It's time for another edition of Trade Talk Tuesday. So, as I'm sure you know, most of our recent picks are on fire. Like, I'm sure you remember AMC. Just yesterday, it was up 30% on Amazon takeover speculation, which is like just what I laid out. And you've been sending me a lot of great testimonials. Let me read this one off for you. Rick R says, Bryan, great call on AMC. Followed your suggestion and sold this morning at 126%. Thanks. So awesome job, guys. I want to quickly review some of our other trades because a lot of them still remain in play. So remember Nestle. Just last week, CNBC reported that in March, Americans bought $275 million worth of frozen pizza, which is a 92% increase over the same period a year earlier. So as I told you before, Nestle owns the top selling frozen pizza brands in the world, but investors have yet to catch on. Instead, they're valuing delivery pizzas like Domino's Pizza, who trades at a PE of 35. Or they're valuing Papa John's, which trades at a PE of 55. But a frozen pizza company like Nestle is a really great value pick right now, trading at a PE of 24. So I think it's undervalued. I think it continues to be undervalued, and it's still a great pick going forward. Then you have Budweiser. Now, I don't know if you've taken any, quarantine walks as you've been locked down, but I sure have. And what happens is every single time I'm taking a walk on garbage day, I see my neighbors' recycling bins just overflowing with wine bottles, beer bottles, recycled beer cases. So clearly people are consuming a ton of alcohol in this lockdown period. And now there's Zoom happy hours, which I guess are a thing. So with Budweiser, as soon as bars and restaurants reopen across the world, Budweiser stands to recover. So I continue to like Nestle, continue to like Budweiser. But for today's episode, I want to switch gears a little bit and get into a company that I don't like. So as you're going to soon see, the valuation of this company makes no sense. So get ready here because I'm about to take a huge deuce on Shake Shack. Okay. Right now, I think Shake Shack is one of the most overvalued stocks on all of Wall Street. And so everybody knows, you included, that every restaurant has suffered for the last couple months. For Shake Shack, their sales fell by over 70% in the final week of March. So compare that to McDonald's, which their sales dropped 50% over the same time period. And you have McDonald's is like the global benchmark, and Shake Shack's sales are falling even more so than McDonald's. But when you compare the valuations of all these burger and fry companies, the kind of like disconnect that's happening right now becomes very clear. So let's take a look. McDonald's currently trades at a forward PE ratio of 30. Then you got Wendy's trading at a forward PE ratio of 37. And then there's Restaurant Brands International, QSR is a symbol. They own Tim Hortons, Burger King, and Popeyes. And they have a forward PE ratio of 17. So then you got those three major players, and then you compare them with Shake Shack, who trades at an absurd forward PE ratio of, are you ready for this? 384. That's 12 times higher than McDonald's and 22 times higher than QSR. I mean, it's insane, especially when Shake Shack has the most exposure to New York, which has one of the most restrictive measures in the country right now. Okay, so how can anyone justify paying 200 times projected 2021 earnings on Shake Shack? Let's take a look and see if we can figure this out. I mean, maybe investors are paying for that much future growth. It's a good thought. I mean, growth always drives up a company's valuation. However, looking at Shake Shack, they've paused the design and construction of all their new stores during this crisis. So that's currently kind of a problem. I mean, yeah, sure, management is optimistic that they'll restart their expansion plan once the conditions improve. But honestly, not pricing in any unforeseen changes to their expansion strategy seems pretty short-sighted right now. Okay, so maybe investors are banking on their leasing terms and discounted real estate costs going forward. Maybe they'll negotiate cheaper costs for their restaurants. Okay, fine. I mean, I admit that's one factor that might help. But honestly, most people right now are pointing to Shake Shack's new curbside pickup or their digital ordering for their premium valuation. And to that, I say, I don't know if you've seen Shaq's makeshift drive-through stations, but to me, they resemble a high school car washing fundraiser, which is happening in the parking lot. That's one hell of a premium to pay for a stock that's not creating any new technology, but simply offering the same old burgers and fries, all at a crazy premium. So bottom line, compared to their peers, the valuation of Shake Shack just cannot be justified, which is why I'm calling them the most overvalued stock on Wall Street right now. All right, and there you have it. That's my Trade Talk Tuesday video for this Tuesday. If you like this, I invite you to sign up for my Trade of the Day service. You could sign up right here in the description below. Every single day, I will write up my top trade and send it to you for free. So sign up today, and I will see you here for Trade Talk Tuesday next week. On that, cue my exit music.